Hey everyone, welcome to another episode of Mortgage Fundamentals Podcast. I'm your host and subject matter expert, Daniel Mosqueda, here in Las Vegas. And today I am joined by one of my colleagues and someone I have just actually recently started working with, Kim Fernandez. How are you?
Good. Thanks for having me.
Thank you for coming, actually. It's been really hard getting Kim to come in here because she's been pretty busy lately, but I'm glad we've been able to make this work. So, Kim, go ahead and tell everybody about yourself.
Well, say thank you for being persistent and not taking a no. So, hey guys, I'm Kim Fernandez. I'm a loan officer here in Las Vegas. I've been in the industry now for 5 years and I absolutely love it. Love everything about it. I especially love working with first time home buyers. And from, I mean, really, from A to C, we've worked with many investors. I've gotten a lot of experience with investors doing non QM loans as well, aside from traditional products. So, kind of little expert in everything.
you know if that's the key thing, right? When you're in this industry or you're in this profession as a loan officer, and this is a little bit off topic for what we're going to talk about, I don't agree with loan officers that say they specialize in one thing.
Right.
You know what I mean? Because as a good loan officer, your specialty is getting people into homes.
Exactly.
Right? Not I only do VA loans or I only do USDA or whatever the case may be. It's always
And that also limits your potential as to how many families you can actually help.
Yeah.
So yes, if you keep the mind open to constantly not educate yourself and constantly be up to date with all the different products, it allows you to help even more families.
And that's the way I look at it.
Yes.
And that's why I like looking up down payment assistance programs. Anyways, though, so today's topic, me and Kim are going to cover what the differences and similarities are for FHA and conventional loans when it comes to first-time home buyers. As you guys may or may not know, when it comes to purchasing a home, there are a lot of different programs to help people get into these homes.
Right.
Some are a little bit better suited for others, but based on income, credit scores, location, field you work in, like we talked about VA.
Right.
And it's really important that we at least give you guys a little bit more information or an insight as to what we're thinking about when we're advising you or suggesting why we think this product would be better versus
Right.
another one.
Right. Well, yes, I will say anytime I'm working on an application, I automatically shoot for that best product, that best program that I feel is ultimately the best one for the buyer or the borrower. However, I do also lay out their options because like you said, the programs differ in many ways. One of them could, have higher cash to close than another, but that other one could have a lower payment. And so I like to show the options to the borrower and let them decide ultimately what's most important. But I do automatically head to that best program that's out there that kind of has a little bit of everything.
You'll notice that for our company, or at least the way we work, and somebody had mentioned in the previous podcast that I was just recording that we're unique in some way, that it was actually somebody from a different company laid out that we are pretty adamant and pretty consistent about laying out different options. Even if we feel one is the best one, we take advantage of those cost worksheets or those ways to kind of show them the differences between a few different programs, right?
Oh, yes. Because you don't want people to feel like you are telling them what's best for them, or you're telling them what to get, or you're almost pushing them to a certain program. No, because the reality is, people tell me all the time, "Oh, Kim, what do I qualify for? Oh, Kim, what's the interest rate?" Well, I don't know how to answer that because the reality is you probably qualify for a number of programs.
Yeah.
And the interest rates differ in these programs. Yeah. And so that really my answer is, well, let me see your application and I'll tell you all the programs that are available to you.
Yeah.
And let you decide. But yes, we do a good job at, listing a few programs to compare to. And that really, even more so, I feel it gives people, or it makes people feel empowered that they chose their financing options and they weren't told what to use. They weren't told what rate they had to have. And it almost let them drive the transaction overall.
Yeah. I think some people need more of the guidance, but some people want to have more of their hands on the wheels than others, right? So there's always going to have we're always going to have a few different forms of buyers. And that's a great point that you brought up. You're going to give them different options. And when they ask, what do I qualify for? I go, that's not how this works. I literally say that that's not how this works. I'm going to be straightforward with you. We want to make sure that we're looking at it because you might qualify for more with this program or less with this program because interest rates are different. mortgage insurance, PMIs are different.
Debt to income ratios are
The
different.
debt to income ratios are different. So there's a lot of levers that us as loan officers are constantly moving up and down. You know what I mean? There's even smaller ones that we try to really think about in our head and not bring you guys into. But our job is to make sure we know what happens if I do this.
Right.
You know what I mean? And if I change that.
Right.
You know, and we also want to take into consideration when we're having these conversations what the client wants or what the client needs, right?
Right.
So
yeah, I always tell them, you have an initial conversation with them, right? And right off the bat, you can tell what's more important. You have those people that are very budget conscious, right? So that tells you no matter what the most important thing for them is a lower payment, right? Lower payment's important for everybody. However, there's others that they're a little bit more flexible on that monthly mortgage. They just want to be approved for the max. They want a bigger house. They want a house with a pool. So they're like, oh, I don't really care what my payment is. I just want to qualify for this house. And that lender told me I can't because, of whatever X reason. So, or some people say, well, I'm open to my monthly payment, but I only have $10,000. That's it. So cash to close is important.
Yep.
So really listening to the borrower and seeing what's important to them, what they can and can't do, and then that allows us to be creative and find those programs that's going to keep them within their max, really, or what the max that they could do.
I think I will say this: sometimes clients have rose petal glasses on when they're thinking about these things. But we try to do our best to kind of fit the clients, at least I do, into the closest. But I also try to be very realistic and tell them what you're asking me doesn't exist if it doesn't. You know what I mean? And then I'll tell you the best I can do with this or the best we can do with that, and you do whatever you want with that, or you do what you will. Right. But we do want to listen to the client because that's, at the end of the day, this is something you're purchasing. This is something that they're going to put their money towards, so it's always going to come up because it's a really important topic. You want to make sure that the client feels, like you had mentioned earlier, that we didn't push them into something that they didn't want to do or they didn't want, know. But at the same time, give them all the options that are the best ones. I'm not going to throw in 2 horrible options when I know there's 3 more feasible options. You know what I mean? Or I just put in mine, and then whatever the client says he wants to do or she wants to do, whatever they want to go with. Because some clients will just adamantly say I just want to do conventional and that's it, or I just want to do FHA and that's it. And I'm like, okay.
And then that prompts okay, can you tell me the reasoning why? And 9 times out of 10, it's for a wrong reason, because of a cousin or family member told them something totally absurd about the program that it's completely a lie. So then you educate them on why that's a lie, and then that opens up their mind, like, okay, I thought that I had to go this way, or I thought I needed this. But
there's a lot of experts out there that aren't in the industry, huh?
All the family members are experts. All the parents that bought 20 years ago are experts.
Those are honestly, that one hit a note, because that's honestly the truth. It's god awful truth, but it's that's why you need to talk to a lender,
to an expert that's currently in the industry, that is currently going through, or constantly going through the process themselves of buying and selling. And pretty much not only are we experts on the I guess the work part of it, right? We do this for a living, day in, day out. So we see the differences, we see the changes, but then I think I can speak for most colleagues that I know, we're always constantly buying and selling. So we always stay up to date on that end as well, as an actual buyer, and that experience.
You got to know that experience. We stay up with the market. We know what rates are going to kind of look like right now. We have an idea. Most of us will keep up with like what news is going to come up and how it could impact it. Some of us tend to be very optimistic. Some of us try to be a little bit more realistic. But whatever the case may be, you know what I mean? It's still a great idea to talk to one of us. So now that we've gotten that part of the way, let's get into what the differences are between FHA and conventional loans. Let's take out our notes here and find out what the first topic was, because it's always hard to keep up. All right, so let's talk about the down payment differences, right?
Okay.
And this is for first-time home buyers. So I'll do the conventional if you want to do the FHA on this one. So for conventional, if you're a first-time home buyer, more than likely you could put as little as 3% down, right?
And you'd be surprised how, to this day, it still blows my mind how many people I meet oh, I thought conventional was 20%.
Yeah. I still don't get it.
I don't get
There's
it.
so much information online now.
Right.
TikTok, Instagram, the clock app, or whatever you want to call it. You know what I mean? The little push play button app, whatever one you want to talk about, they all have the same information.
Right. And I
So
still get the, oh, I thought conventional was 20%. So I thought I had to go FHA. I'm like, no, technically,
Mhm.
conventional is less down for the first time home buyer.
3%, guys.
3%.
3%. And when you think about it, let's just use some numbers to kind of like give you an idea of what that looks like. If you're buying a house for $300,000, that's $9,000. If you're buying a house for $500,000, that's $15,000. And if you want to go to the absolute max of 766,000 something 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 something, that's like $22,000 or $23,000.
Something like that. Yeah.
You know what I mean? So when you're looking at it from that perspective or that amount in money, it's not that much.
Right.
At least not in my opinion, but I do this every day. So, everybody's going to have a different point of view with it.
Right. And everybody has a different budget.
So, yeah, that too. So that's the minimum down payments you can for conventional loans. Now for FHA?
Well, so the minimum down for FHA, which is typically what most people tend to use on their first financing for the first home. Not all the time, but it's the most common. It's 3.5%. So it's 0.5 higher than conventional.
It's 3.5% for FHA. So like you said, it's only 0.5% higher, which is not that much in terms of a difference in payment.
Oh, yes. No, in regards to the difference in payment regarding principal and interest, that 0.5% difference is not going to mean that automatically your payment is lower FHAs because you're putting 0.5% more down, right? So in regards to that minimum down payment making a difference on that payment, no, this specific part is still very comparable to each other.
Yeah. So in a sense, when you're looking at both programs, when it comes to first-time home buyers, they're very close in how much you need in down payment. Yes, you could potentially get a little bit lower of a down payment with conventional, but we still don't know which one is the best one specifically for anybody else.
Right.
If we look at it when it comes to mortgage insurance premium or PMI, now these things are a little bit different depending on if you're going FHA or conventional. So for conventional, I'll tell you this, it's called private mortgage insurance. The reason they call it private mortgage insurance is because we actually have to shop for it through some different companies that give us different rates based on your credit scenario, your credit history, how much you're putting down. Okay. Now with conventional PMI, it can be really cheap if you have really good credit history, or it can be really expensive.
Yes.
So
now this is where some of that determining factor as to which program is best for you.
This
is where we start getting into it.
Yeah.
Because yes, if we're talking differences, you have a lower credit score, you're probably going to automatically drift over to FHA.
Yeah. What's the highest you've ever seen on private mortgage insurance?
I actually ran one today. I knew it wasn't going to work, but I was like, let me just see if I can get it conventional. The lowest credit score out of, I have 3 borrowers on the loan, was a 633. But I was like, I'm just going to do it $1,042 a month. And I said, okay, well, let me go back to FHA. That is the highest I have seen it. And I was like, okay, well, that's not going to work out. So let me go back to FHA.
No. Again, guys, this is why I say it could be really cheap or it can be really expensive. And one of the determining factors, because she brought up a good point right there, was the lowest credit score on the app. There's 3 people on it, you said, right? The lowest credit score is what determines the interest rate and obviously your mortgage insurance on conventional loans, right? The thing is, conventional PMI is, like I said, it's variable. You're shopping for it. We're going to be able to do a couple of things with it. It's going to be a monthly payment, or you can pay it off all at once, but you rarely do that. I think like the lowest amount I've ever seen is like $30 some odd a month.
Yes, 33 has been the lowest I've seen. And that was with like a lower loan to value, so higher down payment. I believe it was at 15% down. And I did shop that one for a lump sum payoff.
Oh, it's cheap.
And it was like $1,000.
Yeah, it's cheap.
So of course the buyer said, yeah, I'm buying it off.
Why not? Yeah. You're basically not going to pay for that just because you didn't put an additional 5% down. Exactly. So instead you're just putting $1,000 down, which is probably...
It was way cheaper.
Yeah.
So, and to add to why, conventional's private mortgage insurance even varies. I like to tell people it's very credit sensitive.
Mm-hmm.
Conventional is very credit sensitive, specifically on the private mortgage insurance.
Mm-hmm.
So yes, if you're on the lower end, even really, even if you're anywhere in the 600s, we're probably going to tell you to move over to FHA.
Yeah, I agree. So whenever I see somebody trying and I'm forcing conventional in the 600s, especially even below 680,
Mm-hmm.
I'm just like, ugh, do
Yeah.
I really want to do this? I already know,
Yeah.
but I'll still try kind of
Right.
situation.
Right.
So it is one of those situations where it's going to be case by case, and this is probably going to be the prime difference. Now for FHA,
So for FHA, I never call it MIP, but I know it should be MIP.
yeah,
But I guess for the purpose of this video, I'm just
hmm
call it MIP. But I do say PMI. I'm not gonna lie. So for FHA, you have your mortgage insurance premium,
hmm
and that the biggest difference is it's not really shopped around. I mean, it's not shopped.
hmm
Okay, it's a set amount. It is based on a percentage of the loan size divided by a certain time frame, et cetera, that determines that monthly payment.
hmm
And that's the same. Like I said, whether you have a 620 or you have a 780, you're going to have the same private mortgage insurance. See, let me correct myself.
It's okay.
You're gonna have the same. Can I abbreviate, or do I have to keep
Yeah,
saying
you
it?
can
Okay,
abbreviate.
you're going to have the same MIP
hmm
on that transaction. Like again, whether it's a 620 or a 780 credit score.
hmm
So if you're in that 600 range, you're not going to, in a sense, be dinged or
hmm
have to pay extra because you have a lower credit score with FHA. So this is where we get into determining what programs are quote unquote best for you,
Yeah,
right?
cheaper
Right,
if you want to talk
cheaper.
about it. That if you want to be cost sensitive, payment sensitive in a sense.
Right.
And the other key thing is so with MIP,
Mm-hmm.
two things actually happen with MIP with FHA. Unlike conventional, you just shop around and your PMI is your PMI and that's your payment. FHA also has an upfront mortgage insurance premium,
Right.
right? So that's 1.75% of the loan amount is going to be added to your closing costs.
Mm-hmm.
But the good thing is that gets financed. You can finance that into your loan. 99% of the people actually finance that
Right.
from mortgage insurance premium into the loan. You could pay it up front if you want to, but I'd recommend just financing it. And then your monthly MIP payment is going to be 0.55% of the initial loan amount divided by 12. So it's going to be your monthly payment.
Right.
Do this thing on my calculator every day.
Yeah.
But those are basically the key differences, right? So
Right.
it's a set amount. It depends. It's always going to be based on the loan amount. You know what I mean? The higher the loan amount, the higher
The higher that
the
MIP is
MIP.
going to be.
The lower the loan amount, the lower
Right.
the MIP. Credit score doesn't matter.
Right.
Down payment only matters because of the loan
Because it's going to
amount.
change the loan amount.
Yeah,
Exactly.
but credit score, you're not worried about it, right? So we're not going to sit here and scramble our heads. Oh my God, is this going to change? You know what I mean?
Right.
So that's a key thing right there for FHA.
And I will add, I actually just found out recently
Mhm.
that not all lenders shop for you when it comes to private mortgage insurance on conventional
Are you
loans.
serious?
Yes, I'm serious.
Oh.
I had a client who was shopping me with a credit union,
Mm-hmm.
and my interest rate was a little bit higher. I think it's common knowledge credit unions tend to have a little bit better rates sometimes, right?
Mm-hmm.
But my payment was like significantly lower. Like I want to say almost $200 a month lower. And she's like, Kim, I don't understand. Like your rate's higher, but your payment's lower. Like, I said, oh, of course, send me that loan estimate. I'll explain it to you in detail and the differences. And yeah, private mortgage insurance was like 450 where I was giving her like $200.
Ooh.
And she's like, and I said, oh, here's the difference right here,
Mm-hmm.
and she's like, well, that doesn't make sense. I have the same loan and, you guys are offering me the same loan.
Mm-hmm.
So why is my insurance higher? Come to find out, apparently that credit union doesn't shop for private mortgage insurance.
They have one specific one.
Yep. And that was it.
There's like 5 or 6 different
Ones that we use.
private mortgage insurance companies that we use for sure.
Yeah.
And they do vary. I've seen some variation between all of them.
Yeah.
Sometimes there'll be a insider tip or information here is sometimes it'll actually be different between, if you guys don't know what Fannie Mae and Freddie Mac are, they're the two GSEs for conventional loans, or the GSEs are basically where these loans get sold to. So there's 2, Freddie Mac and Fannie Mae. And if you go between those two
Yeah.
alone, sometimes there's also a difference.
Yes, there is. Even in rate alone.
Yeah. Yeah, even rates. So
Yeah.
they do the same thing. They're just slightly, sometimes one's cheaper than the other, and some days the other one's cheaper than the other one.
Right.
It's not, one isn't always more expensive than the other one, but one tends to be for some reason regularly.
Yeah.
But that said, yeah, it's, I think what I also wanted to touch on with the credit union thing is, guys, credit unions may always, not always, sometimes have better rates. It really depends on what market we're kind of in right now. But credit unions sometimes are a little bit harder to close with, just like big banks.
Well, perfect example. Again, this specific transaction that I was referring to, I originally was working with her, and through the transaction, she's like, Kim, I'm so sorry, I just, the credit union is giving me a significantly better rate. And I'm not gonna lie, internally I said to myself, it's okay, because I'm gonna see her again in a couple of weeks, because I already knew that her loan was not a cookie cutter ABC type of loan. It took some creativity to get it done. I knew exactly how to get it done. And I said, okay, okay, hun, don't worry. At the end of the day, it's your decision. You can use whoever I tried to be as competitive as I could with the rate. It just wasn't doable to compare to the credit union. And yes, 2 weeks before closing, comes crying, Kim, I don't know what to do. The credit union saying that I'm not approved. We're going to lose our house. You told me that we were approved. And I said, yes, you are.
I told you
what. I can do the loan. And closed her on time within that 2 weeks that was left, because I told my team, keep working on it. We're going to see her back. And she was just so thankful through the roof. I'm so sorry I left in the first place. And I said, it's okay.
It's one of the things, man. Like, sometimes you are going to lose them to other people if they're pretty green. But in all honesty, guys, like, I've probably gotten a good handful of loans because credit unions, and they weren't even originally my loans. They just got brought to me because the people wanted to go credit union, found out it isn't going to work. Now I'm over here rushing the team to do something we've never even seen before and hope for the best. But in all honesty, I have full faith in our team. And our company in general is just really good about making sure that stuff works out at the end. So, but yeah, private mortgage insurance and mortgage insurance premiums. And there's a difference, guys. Like, honestly, I don't know. I know I've been doing this for a little bit less than you, but 4 years. You've been doing it for like 5 years and stuff like that. But you still learn something new every day.
Oh, every day.
And how different companies do different things.
Exactly. And it continues to humble you, but it also continues to magnify even more so how you do need to stay up to date. You do need to stay educated, and you need to be open to finding the yes. So I think it's easy for some loan officers, other places, not Guild Mortgage, it's easy to just, no, we can't do it, or like, oh no, it's too hard. And I think because we're constantly taught something new all the time, it constantly reminds us, like, no, there is a way. We just haven't found it yet. So that we get to that yes. And that I think that's what makes us, different from the batch.
I think that's why a lot of people like working with us in general, is because of that, because they know we're gonna fight for tooth and nail until the end, even if it's on the last day. I have fought for a loan on the last day.
The amount of times I've met an agent and, oh, you're with Guild. Oh, you're with Guild. And yes, I am.
Yes, I am. It's got a good reputation. And I guess just as quick side note, lucky for us, the company just doesn't hire just anybody. You have to have some sort of experience and background to it.
Right.
Because if you just hired everybody at high volumes, you're going to end up doing like what other companies do and just recycle people, and it's not good for the company. So we'll talk about the next thing, interest rates. Interest rate differences.
How do they differ between the programs?
How do they differ between it? So I'll start off with conventional again. Now, conventional usually, on 9 times out of 10, is usually going to be a bit higher than its FHA counterpart, except sometimes if you're doing one of those programs that they have, like special ones for Fannie Mae and Freddie Mac that are 80% AMI or lower, sometimes those tend to be better rates. And sometimes one of the programs we work with right now, depending on what area you purchase in,
Yes.
it's even a better rate. And I'm
Right.
actually using that program right now with one of my clients where I was like, this is even lower than an FHA rate.
Yes.
And it doesn't cost anything,
Yeah.
which is ridiculous to me. But
But
usually conventional loans are a little bit higher. But again, you really can't tell with conventional loans. There's just such a big
yes.
pool of products, I think.
Exactly. And so I tell people it's very specific to someone's application.
Mm-hmm.
So the slightest thing can make a difference in that conventional rate.
Mm-hmm.
Whereas going back to FHA, it's very standard. It's very, hey, as long as you are, meet these criteria, you're going to be the same,
Yeah.
regardless if you're, from A to C.
Mm-hmm.
Whereas no, conventional is A is different, B is different, C is different.
Mm-hmm.
So it's very specific to an application.
Yeah, it's very specific to an application. The sub programs to conventional. There's like subject AA if you really think about it, because the difference also comes in the loan amount, the purchase price amount, condo versus property type,
Yes.
condo, manufactured home, townhouse. I don't know what else there is out there, but something.
And then to your point, even property location.
Property location
there's programs that are specific to the location. As
exactly. Far as so you gotta just really be open to like thinking about what programs we kind of show you guys when it comes to the interest rates, because if you say, well, I see an interest rate on this for this, well, we have to compare apples to apples. We got to figure out which program that interest rate is to. You know what I mean? So it's just, conventional usually higher, but not always.
Not always.
Yeah. And like you said, FHA is one of those things where it's just, if you have a 680 credit score to a 720.
Yeah. It's such a big window. Really, from experience, it's from a 620 and above.
Yeah.
The only time I see a difference is from 600 to 619, 580 to 599.
Those costs get so high there.
I was saying that, so yes, with FHA, it's such a big bracket from 620 to and above. It's pretty much the same. You see a difference in regards to the cost of rates from a 600 to a 619. And then you see a difference from 580 to 599, again, in the cost of the rate. And then when you get under a 580, in our case, it's from a 540 to a 579, then you also see a difference in the down payment requirement, right? So from 580 and above, we require a 3.5% down payment.
We forgot to bring that up.
Yes. So from a 580 and above with FHA, we require a 3.5% down payment. Whereas if you're at a 540 to 579, you can still obtain financing, but we require 10% down. So yes, I guess it's safe to say that under a 620 with FHA is where you start seeing your differences, right? And again, it's going to vary. I know they even differ per lender. I've seen lenders have different credit score requirements, but it's safe to say 620 and above, you're kind of in the same bracket with anything. Yeah,
you're all in the same pool of people. You look the same to everybody. You're like, everybody is just like a big question mark, but no one's a little bit different in any way, so you're all gonna obtain similar pricing or almost the same pricing, right? Now in terms of like the different credit scores, we won't get into details on that, but some banks have different overlays.
Right.
So that's a key difference when you're looking at different places that you're going to go with. But that's pretty much all you need to really cover when it comes to interest rates for FHA and conventional loans, right? Now the credit score differences, we touched a little bit on that. So let's talk about it a little bit more though. Now conventional minimum credit score is 620. I don't suggest you purchasing a conventional loan with a 620 for previous topics we talked about. So when you're talking about a conventional loan at 620, you are talking about you're going to get the highest LLPAs when it comes to the interest rate. You're going to get the highest mortgage insurance premium when it comes to it, right? And you're pretty much going to get the most findings, and findings are what the underwriters are going to ask for in terms of making sure your loan gets approved when we run it through our AUS system, because they're going to want to verify everything in everyone you probably know at that point.
Yeah. And if I'm being honest, it's not very easy to get an automated system approval with that type of low credit score on a conventional loan, especially as a single borrower. If you have a couple borrowers on the loan, then it kind of opens up the possibility of it. But honestly, the reality of it, the private mortgage insurance is so high that you don't even get that far.
Yeah, it almost makes it like not impossible, but it makes it like a null point or a null reason to even bring it up.
Right.
You know what I mean? It's going to be 1/3 of your payment.
Right.
in some cases, or even half.
Yes.
So
It's if you're trying to best advise your client, you're trying to get them the lowest payments, you're trying to get them the best rates. If you're
mhm,
at 620 and we're going conventional, this is probably not your best option out there. We'll talk about it if it's an option. If you ultimately, for some weird
mhm.
reason,
Yeah,
are stuck with having a
yeah,
conventional loan.
yeah,
I mean, really, the only thing I can think off of the top of my head why somebody will insist on a conventional loan at that lower credit score is if the specific property they are wanting to purchase does not accept FHA
yeah.
financing.
Sometimes it's condos.
Mm-hmm.
Sometimes it's a flipped home, depending on how many days
Right.
it was recently built. But even then, is it really worth it?
Right.
You know what I mean?
In my mind, it's not.
And on topic, off topic, sometimes as loan officers, we need to walk people off a ledge.
Mm-hmm. Yes.
We're basically trying to unconvince you in your misinformed,
Yes.
circumstance you're coming in here. Yes, you probably come in here with the best intentions, and yes, you may have done your research,
Mm-hmm.
but we've done ours.
Mm-hmm.
And most of the time, there's just maybe slight differences in what you're reading versus what we're reading. And it's because your loan application is different or your
Right.
credit score is a little bit different. You know what I
Right.
mean? So,
And morally speaking, I honestly feel like I won't be able to sleep at night if I push somebody into a loan where their payment is $500 higher, than their counterpart, and that they could, just because they qualify, that they should go
mhm.
for it.
Yeah.
If you absolutely want it, I will talk to you about it. But
Mhm.
I'm sorry, I will have to say this is not the smartest decision.
Yeah.
It's not my mortgage payment. It's not my home. But like you
Yeah.
said, we tell people
I
off the ledge. Just because you
strongly,
could get approved does not mean you
yeah,
should do it.
I want you to come over here, listen to me. Let's have this conversation. But at the end of the day,
Yes.
your decision.
It's your
All
decision.
right. So when you see that CD at the end of it, don't say we didn't have that conversation. Now let's talk about the other ones. Programs available. Now I kind of talked about it a little bit earlier in terms of like F conventional has different programs, right? So we have regular Fannie Mae and Freddie Mac
Right.
programs.
Right.
We also have their sub programs like Home Possible and Home One,
And home ready.
and Home Ready, which are more tailored for like either lower income buyers.
Right.
Yeah, they're mostly just like lower income buyers.
Right. They're specifically lower income. In some cases, first time home buyers. For
Mm-hmm.
home one, you have to be a first time home buyer. Is
Mm-hmm.
that home one or choice home?
Ooh, I don't know.
I want to say home
See,
one.
now I got to go do some research.
Right. Now we're gonna go pull up the guidelines. But yes, because even for home ready, you don't have to be a first time home buyer. But yes, that one is lower income.
Yeah, you have to have,
Mhm.
I think it's usually 80% AMI of the location you're purchasing. If
Right.
you guys don't know what AMI is, or area median income is
Correct.
the one, just look up area median income in your location. For the most part, they're not very high.
Yes. Yes.
Okay, you're not making very much money. And there are even some programs that even in these programs that give you more benefits if you're 50% AMI or less,
Yes.
right?
Yes.
So, oh, and these programs also give you better MI.
Yes, they do. They do have a better private mortgage insurance on these programs.
Mm-hmm.
So, yes, if I have someone that's within that income guideline, I would say, then
Mm-hmm.
I'm automatically going to shoot for those.
Yeah.
It's going to give me a better rate. It's going to give me a lower payment on that private mortgage insurance. And in some cases, they also have additional grants that you can
Yeah.
add to them.
Yep. And I've seen
Mhm.
some special ones that sometimes come up. Again, this is why it's good to read and
Mhm.
keep up. And that's why I really love the emails they send us on these things. But these are some of the reasons why I'd probably push a buyer, especially if you're lower income. It doesn't even have to be a lower income. These are some of the reasons why I would push
Mhm.
somebody to go into that. The other thing is some down payment assistance programs only work with conventional loans.
Right.
You know what I mean? Sometimes
Right.
you have to, it's not even down payment assistance programs, more like grants or
Right.
other, what do we call them? Caps or DAPs?
Yeah.
So additional funds that we can help your special programs out there that we can help you guys with your closing costs or down payment.
Right.
So with FHA though,
FHA, in my experience, it's kind of restricted to down payment assistance programs
mm-hmm,
or obviously grants. Grants are open to be used in with any traditional financing for the most part.
mm-hmm,
But conventional programs like the ones you were mentioning, Home
mm-hmm,
Ready specifically, they have additional grants that could be paired with either a traditional product or a down payment assistance program. So
Stacking.
yes, kind of you could stack those,
Mm-hmm.
and they're not huge. They're 1,000 here, 2,500 there, 650, 6,500 here, but
Or
they
pay for your appraisal.
ultimately,
There's one that does
yes,
that as well out of
yes,
it, or credits you for it.
right,
But conventional, I think in this case is always going to be slightly more, give you more options, because FHA is pretty straightforward. FHA has its FHA program,
right,
and then FHA has its 203K limited or 203K, which is the constructions loan.
right.
But conventional also has something similar. I don't want to get into details because that's a whole can of
Topic
worms
on
in
its own.
itself. But if we were to stick to standard products, conventional has more options, more tailored to try to help more buyers.
Yeah.
If you got the credit score for it.
Yes.
To do
yes.
it. So you could be low income and still have great credit
Yes.
and take advantage of some of these things.
Yes. Yes. I think that I love that you just said that. Specifically, she just closed yesterday, and
Mhm.
I am still beaming from the amazing deal that I feel like she got.
Yeah.
First time home buyer.
Mm-hmm.
She qualified for a grant.
Mm-hmm.
So she qualified for a grant. It was a
Mhm.
$30,000 grant.
Mm-hmm.
In addition, she qualified for another grant of 4,500.
Oh, the two grants.
Yes, stacked both grants.
Did you do them both with the same person?
I did them both with the same person. Of course I did. I said, throw it in the bag.
Yeah,
Anything
yeah.
we can get her.
Yeah.
Because she had amazing credit.
Yeah.
Extremely low income.
Yeah.
Now, I will add, she was buying within her means.
That's
which
good.
is where a lot of people struggle.
Yeah.
But she bought this gorgeous condo.
Mm-hmm.
Okay, it within her means, it just exactly what she needed. She's a
Mhm.
single woman. She didn't need to go crazy or anything.
Mm-hmm.
But with the 34,500 plus that small amount she had to come in with for the grant for the 30,000, you have to come in with at least 7,500,
Yeah,
so that you
it
can get
matches,
the full
because
30,000.
it gives matches 4-to-1, right?
Exactly. So just to kind of estimate, she came in, with 41,000 about, right, with her
Mhm.
grant and her 7,500. Payment on her condo is going to be $961.
Unheard of.
Unheard of.
Today's market.
She can turn around now. She can't, because it's an owner occupied purchase. But
Yeah.
I mean, she could literally turn around tomorrow and run this thing out for $1,300
Yeah.
and make a profit.
Yeah.
Right. I mean, she just had what I would say like an overall great application. She's had her work history.
Mhm.
She had no debt. I mean, I think it was a couple credit cards with very small payments.
Mhm.
She lives and stays within her means.
Mhm.
And she, most importantly, had good credit. She had good credit score.
Yeah.
In this case, this was the perfect scenario for her.
Yeah.
She took full advantage of the best grants that were out there for first-time home buyers. Got an amazing deal pricing on the home. I want to say it even appraised higher than what she was buying for it.
Mhm.
And she set herself up for success.
Mhm.
And very young girl. So again, I love working with first-time home buyers. I get even more excited when they're young.
Younger. You're like, wow, when I was your age.
Right. You're like, I think to myself, like, you're so cool. I love seeing the young crowd get into like the home buying process.
Yeah.
But yeah, so it was just, now it wasn't an easy process on the lending side, I will say.
That
Grants are
30,000
not easy.
The $30,000 grant one is probably one of the most strenuous programs to go through. It's because it's going to actually be free money at some point.
Yes.
And that's a lot of money to just give away.
Yes.
It is a lot of work on the buyer. I don't want to sound petty or anything, but it is a lot of work on the lender.
Yeah.
You know what I mean?
I did want to add, I actually saved this from another lender.
Did
who,
you?
Was not responding. And
because they thought, I don't know if it was a boy or girl, but they probably thought it was like a dead deal.
Most lenders don't like to work with grants and down payment assistance programs. We got the contract within a week of it being in escrow.
Yeah.
And closed it within I believe it was 29 days.
With that program?
Yes.
You know how long they're behind?
I know. I know. Still dusting my shoulder off.
I wanted to point out two things there. First off, getting that grant, we could say the Wish program is pretty hard to work, not hard to work with, but it's very hard to qualify for it because there's so many things you got to do beforehand, preliminary wise.
Right.
And it's one of those grants I've been trying to get done with some of my clients, but it's always, you have to have like the perfect storm of a client in order for it to work.
Oh yes.
You know what I mean?
Yes.
And especially stacking it like you
Yes.
did, it's commendable. And the thing I want to add on top of that is, as a lender, it may sound geeky, and this is going to be a geeky thing
Yeah.
for me. I can understand like why you feel that way, because it honestly is a big win.
Yes.
You're like, I did it. I've been
I'm
trying
still
to
like
do
sitting there
it.
like, I can't believe that happened.
Yeah, I've done it. I can put this on my resume wherever I go,
Yes.
kind of situation. I'm gonna stamp that on a t-shirt, wear it everywhere.
Right. I closed
Oh
the loan
man.
with a grant in 21 days, and
Yeah.
I stacked it with another grant.
Yeah. And I did it with Wish. That's
Yes.
commendable. I did something, I wouldn't say with Wish, because Wish is, like I said, really hard, but I did it with that $35,000 grant, and then we found out about that other grant when it was a little bit more money.
Yeah.
And that one was only conventional, and that was the situation there with only it being available conventional. I was able to get her close enough to the same amount, 42.5.
Yeah.
Because you got the 35 plus the
Right.
7,500,
Mhm.
and the client basically walked into a house for under 120,000, which is very unheard of.
Yeah.
And it was a townhouse, actually.
Oh wow.
Yeah, even better.
Yeah.
And then on top of that, she got the seller credit. So I'm sure yours got seller credits
Oh
on
yeah,
top of
and
that.
I used some of that seller credit to pay for her HOA up front.
See?
So her payment's gonna be pretty low, at least that first year when she settles in.
And that's the beauty, guys. This is why we do what we do, because honestly, it is really exciting when you actually do things like this. You know what I mean? Simple ones. I love simple loans too. Don't get me wrong. If you're a simple loan, come on in. But these are just
and the client didn't even know about that $4,500 until she closed, because I was like, I'm not mentioning it in case it doesn't go through, but I was like, throw it in the bag.
Oh, nice.
Yeah, so she didn't even know there was an additional grant.
So it was like a little
bonus.
Christmas in July.
Yes, exactly.
Because it was still July when you closed it. There we go. Oh my god, that's actually.
But
really
that was back to the original point. That was with a conventional product. Obviously, it just benefited her to go conventional
because of all of that.
Her loan to value ended up. I want to say it was about 85%.
Helps with the MI.
Her MI only ended up being. I want to say it was the. Oh no! I bought off the MI because that's how much money
you were able to use the money from that.
I bought off the MI, so she had no, even with 85% loan to value, she had no private mortgage insurance. Yeah, we bought it off. Paid the HOA up front for 12 months. It was just an overall amazing. I don't and you know what, like you said, like the geeky part as a lender is I don't think she realizes how amazing the transaction was. I don't think she realizes what good of a deal she got. But on our end, I'm like, oh my gosh, we did so much. Yeah. And then the time frame that the team got it done was amazing.
They don't have anything to compare it to. That's what it is, right? Like if you do this on an everyday basis, you learn to you compare one to the other, not because you're like, oh, this was a crap deal or this was a good deal. You try to be like, oh my God, I can't believe I actually got away with this. And comparing your loans too is where we learn how to do certain tricks.
Right.
You know what I mean? So
yeah,
kudos to all of us when we learn more. But anyways, the next topic, guys, that way we can make sure we go good on time, is IPCs.
Okay.
Let's talk about IPCs. So IPCs, guys, is just a little fancy jargon word, which is interested party concessions, also known as seller concessions, or at least that's the most common one that we use.
Right.
There are other forms of interested party concessions or seller IPCs, but the most common one that we normally run into is that. For conventional, it's a little complicated when it comes to IPCs. You can get as little as 3% from the buyer of the purchase price up to 9%, depending on how much you put down. Right. If you put 10% or less, you can only get up to 3%. If you put 10.01% up to 15%, or is it 25%?
Is it 15 or 20? Now I gotta check. I thought it was 20, and then you can get up to the 9.
Ooh, we're gonna check that right now, guys, for you guys.
I'm sure we can find it.
Regardless, there's another number there.
Yes.
While she looks that up, another one that you can go up to 6%, and then the last tier allows you to get up to 9%. Now, how realistic it is for you to actually get the full 6 or 9% from a seller is gonna be impossible. So don't really worry about it. But it's a good thing to know, because sometimes you are able to get the full 3%. Sometimes you're able to even get 4%, depending on how, I guess you would say, motivated the buyer is, seller is. You know what I mean? In terms of doing it.
Right. And I mean, how big the pockets are.
Too. Yeah.
Because let's be honest, I would say in today's current market, you you see the biggest percentages of IPCs given from builders.
Yeah. Yeah.
Yes, they have the
So
money to play with.
so that includes resale. So IPCs, these rules apply to everyone, including builders and also to resale clients. To make sure that, I'm not sure why they're there in terms of a limit, but they're there. You know
Right.
what I mean? And then for FHA, you can get a flat 6% no matter how much you put down. You can use a down payment assistance program and still get 6% in IPCs. And mind you, down payment assistance programs and grants don't count towards these things. The only thing, because they're not an interested party, so the only people that are interested parties would be like us as a lender. With the FHA, it's a flat 6%.
Yes.
So it doesn't really matter what you do. But that's what I was gonna say. Down payment assistance programs, grants, DAPs, or anything like that don't count towards these because these aren't interested party individuals. They're just programs there to help you get into homes. Interested
And
parties
who falls under an interested party?
it would be lenders,
Mm-hmm.
sellers,
Mm-hmm.
realtors, real estate agents.
Mm-hmm.
I think that's it, right?
Is it? I believe a title
Title company would
because they're getting
fall.
paid too.
Yeah, so anybody involved in the
I would
transaction.
say anybody's getting paid is an
Yeah,
interested party.
anybody who gets any kind of money from this transaction is an interested party. So, take that information for what it is when you're trying to calculate how much you can actually get from a seller when it comes to these things. I know that there's going to be some differences starting sometime soon in terms of the real estate agent commissions, but I think those don't count towards it either. I think those are done separately still, but it could be different. It could change.
I believe. I guess it's up in the air. I don't think there's a direct guidance yet.
So nobody's brought it up,
No,
kind of situation.
we're all going to
Be.
be learning together. Is what it feels like.
So
Okay, I did pull it up.
Oh,
Though.
there we go.
Okay, so this one I did learn this one recently. Again, goes back to you learn something new every day. Invest on conventional loans.
2% only.
Correct. On
2%
investment
max.
purchases
Yeah.
is the max you can get.
Yes. Very important.
And that's no matter what you're putting down.
Mhm.
Obviously, minimum down is typically the 20%.
Mhm.
But even if you put 50% down, you're still capped at the 2%.
Yeah. And it's 2% or 4% or 6% of the purchase price.
Right.
So keep that in mind.
So conventional, regular conventional, like you said, it's at the 90.01 or greater is 3%, right?
Okay.
So anything less than the 10% down.
Yeah.
If it's the 10.01 to 25.
Oh, it is 25.
Yeah.
Okay.
Yeah. Then that goes up to the 6%.
Okay.
75% combined loan to value. So 25%, 25.01
Yeah.
or more
Yeah.
is when you can go up to the 9%.
Yeah, which is not very likely
But
to happen.
Fannie Mae Home Ready
Okay.
first says 90.01 or greater. So meaning anything 10.01 and above that you put down is 5%.
Oh, 5%?
Mm-hmm.
No matter what?
It just says 90.01 or greater. So I'm assuming anything.
LTV. So that means lower than 10%.
Yes. Yes.
So if you put less than 10% down, you can do up to 5%?
For Fannie Mae Home Ready first.
We learned something new today, guys.
Yeah.
Got to bring that one up to our project manager tomorrow and find out what she says.
Yes.
But that's actually good news.
I know, because we use that program a lot.
Yeah.
Okay. Nice. Look at us.
Okay. We got to do this more often, huh?
Yeah.
But yeah, so in a sense, those are kind of like, I guess you would say those are all the main differences, right? So just to go back and circle back to what I had said earlier, there's a bunch of levers and a bunch of things. So it's not okay, or it doesn't make sense for you to come up to us and say, I want this rate or I want to do this program and that's it.
Right.
You know what I mean?
Right.
That would only make sense if you found out about a program like a down payment assistance program or a specialty program.
Mm-hmm.
Then yeah, let's look at that option. But when it comes to comparing and contrasting and trying to find the best program, whether it's FHA or conventional for a first-time home buyer, it's not black and white.
Right. It definitely isn't. And I would say as a buyer, as a borrower, you don't want it to be black and white, right? Because that means either yes or no. And there's no in between.
Yeah.
And so no, you don't want it to be black and white. You want a lender that's going to see all the colors in between,
Mm-hmm.
because that opens up more options to you. That, I mean, that can make the difference of opening up the option from being told no to yes as
Yeah.
well.
No, absolutely. And the last thing I wanted to touch on is something you had mentioned earlier, and it was in my head, was that you said not everybody wants to work with certain programs.
Right.
And we literally just talked about that in my last podcast that I was just filming. It's a fact, guys. If you heard about a program that we offered or we mentioned to you guys and somebody else isn't doing it, not everybody does it for a few reasons. One of them is what you've mentioned a lot, which is if it's more work for them,
Mm-hmm.
sometimes they don't want to do that.
Right.
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 The other thing is some companies will pay their lenders a little less, so they don't want to
Right.
take on that burden to work harder
Right. For less pay.
for less pay.
Right.
So, it's always a good idea to look for a very reputable lender that's working with these programs. We try to work with all of them. I'm pretty sure we work with a majority of them that we can.
Yeah, and if we're not, we even look into being able to work with the
Hence, the
program.
4500 one was something we
Exactly.
just recently found out about, actually.
Exactly. Sign me up.
Yeah, exactly. So, all in all, guys, I think, just be mindful, be open-minded, and ask questions,
Yeah.
right?
Yeah.
To get a better understanding of what you're going to be getting into. So,
Yeah.
do you have any final thoughts on this?
I mean, no, I hope people found it valuable,
Mm-hmm.
some of the information that was shared. I really think that the biggest thing that I always try to circle people to is finding a lender that fits with you, that matches with you,
Mm-hmm.
that you feel like
Mm-hmm.
they're literally looking out for your best interests.
Mm-hmm.
And it, and trust me, it's not hard to do so if you're doing it, you know, if your morals are right, it's
Mm-hmm.
very easy to just always walk in with the best intentions to look for the best programs for the bar, listening to them so that they tell you what's most important.
Mm-hmm.
And at the end of the day, that if anything, that what makes it more exciting for me is I want to be the one that tells them yes. I
Yeah.
want to be the one that gets it done for them.
Mm-hmm.
I want to be the one that was a part of this family's,
Mm-hmm.
process of owning a home,
Yeah.
of getting into their first home, because you never forget your first.
You don't.
So trust me, if that's you won't forget me,
Yeah,
because
yeah.
you're gonna remember, oh, that loan officer, what was her
Yeah.
name again?
Yeah. Just make sure you guys, it's honestly the truth, guys. So you find the best team. And I say this every podcast, and I'm going to keep saying it every podcast. You are setting up and creating your team to help you get into your home. And I know you guys are going to hear this a million times if you're listening to every episode, because your lender is part of your team. Your real estate agent is part of your team. Your title company is part of your team.
Yes.
And you are developing or setting together your Avengers, in a sense, to get you to the end. Or just like any other corporate office, you're always going to try to get the best team in there,
Right.
that's going to work for you.
Right.
You know what I mean? And you're part of your team.
Yeah.
So make sure, like you said, you work well together, you mesh well together, and it works.
Yeah. We're gonna make it happen together.
Yeah. And the other thing is, I did find it helpful because I just found out about that 5% thing.
I know. I'm gonna go and dissect the guideline and be like, wait, did I read this right?
Yeah, that's gonna be the first thing we do, is look at our computers right after this. But anyways, guys, I just want to say thank you guys again for tuning in to the Mortgage Fundamentals podcast. I hope you guys found this information helpful. If you or anybody else wants to learn more about mortgages, please feel free to follow, subscribe, like, or even share this with anybody who may be looking to purchase a home in the future. You can contact me here through YouTube and leave me a comment below to let us know if there's anything you guys want to talk about. You know what I mean? We're open books. We're very well educated, and we love trying to come up with topics that you guys would enjoy listening to. But yeah, leave a comment. Follow me on TikTok. Follow me on Instagram. Follow me on Facebook, whatever the case may be. And I hope you guys have a wonderful day. Thank you, guys.